A very good hello to our beloved lecturers and our fellow students. We are Group 4. In this video, we are going to be presenting the steps required in the preparation of business financial recording and reporting. These are the members that will be presenting in this video. Before we do, I will give a brief introduction on what is financial accounting. Financial accounting is a process that involves identifying, analyzing, and recording a company's accounting events. It is a standard process that begins when transaction occurs and ends with the transaction being included in the financial statement and the books being closed.
Firstly is to record information in a journal. A journal is like a diary where information such as the date, amount, and other details regarding transactions is recorded. General journals are to record information that does not belong in special journals, such as journals for purchases, sales, return outwards or inwards, cash receipts or payments. General journals record sales or purchases of non-current assets on credit, correction of errors, opening entries, transfers, withdrawals of inventory for owner's own use, and adjustments. So if we look at the journal entry format, firstly, at the left hand side is the date, and next to it is the account title, and firstly is the debit, which is on the left hand side, and credit, which is on the most right hand side. The debit always comes before the credit. And to record the date, firstly we will list down the year and of course the month and day. The account title records information such as cash, capital, and the debit is recorded first, then the credit. Each day where a transaction is made must be recorded, and if multiple transactions take place in a day, then they must also be recorded. What needs to be recorded is including each party that is involved in the transaction. When recording debit and credit, there will be an indent when recording the credit under the debit to make it easier to read. We will take a look at the journal entries for DEF Enterprise for the month of March in 2020. We start the business with 40,000 ringgit in bank. That puts it in the debit side of cash in bank. And to complete it, we will subtract our cash in hand by 40,000 to put it in the credit side. Next, we pay our rent with a value of 1,000 ringgit. Then, we will put the debit side of our cash in bank being subtracted by 1,000 due to it being paid by check. On the 2nd of March of 2020, we purchased 600 ringgit worth of stationery by cash. That means that our inventory has increased on the debit side by 600, and on our cash in hand has been subtracted by 600 on the credit side. On the 5th of March of 2020, we purchased 2 motor vehicles worth 30,000 by TH Trading. That means that we received motor vehicles 30,000 on the debit side, while TH Trading has given away its inventory worth 30,000, which puts them in the credit side. Next, TH Trading received 400 ringgit through DEF Enterprise paying through check, which means that TH Trading is on the debit side of 400 and DF Enterprise is on the credit side because their cash in bank decreased by 400. Next, TH Trading received 29,600 through us paying them through Maybank loan, which means that TH Trading's debit increased by 29,600, while Maybank has their credit increased by 29,600 due to them giving out the loan. Next, that means that DEF Enterprise has an account payable increase of 29,600 and their loan account received a credit of 29,600 due to them needing to pay the loan towards Maybank, which means that Maybank is waiting on the loan to be repaid, which makes them the account payable. On the 7th of March of 2020, DEF Enterprise purchased 48,000 worth of soda cans from Soda Berhad on credit. That means that DEF Enterprise inventory received debit of 48,000, while Soda Berhad has their credit increased by 48,000 due to them having their inventory decrease. On the 9th of March, DEF Enterprise paid for advertising through check. It costed 500 ringgit, which means that on the debit side, they receive advertising of worth 500, while their cash in bank decreased, leading to their credit side being 500. On the 10th of March, DEF Enterprise sold 1 can of soda drink to Fresh Berhad for cash 5,000 ringgit. To record this in the journal entry, we will say that the cash in hand increased on the debit side by 5,000, while their inventory decreased, meaning that their credit is on 5,000 for their inventory. Fresh Berhad received items but also paid, which means that they're on the debit side and credit side for the same value, which is 5,000. This is both recording their decrease in cash and increase in assets. On the 11th of March, DEF Enterprise purchased machineries from XYZ Enterprise worth 840,000 ringgit. On the debit side, their machineries increased by 840,000 ringgit, while XYZ Enterprise gave away their inventory to purchases and sales, and it's worth 840,000 ringgit. On the 13th of March, DEF Enterprise paid TH Trading using check worth 10,000. That means that on the debit side, TH Trading received 10,000, while on the credit side, DEF Enterprise had their cash in bank decreased by 10,000. On the 14th, DEF Enterprise returned soda cans worth 4,000 to Soda Berhad because of the check theft. And that means that the account payable has a debit side of 4,800 because the amount that DEF Enterprise owed Soda Berhad decreased by 4,800. On the credit side, Soda Berhad had their inventory decreased by 4,800, making them on the credit side due to the fact that they are unable to sell their soda cans because of the defective nature. On the 15th of March, DEF Enterprise sold 3 cans of soda drinks to Wawa Cafe worth 15,000 ringgit. That means that their sales is on the debit side, increasing by 15,000 ringgit, while Wawa Cafe had their decrease, which on the credit side is 15,000. On the 17th, 29,600 was paid to Maybank loan by check. So to record that in the journal entries, Maybank received 29,600, putting them on the debit side, while cash in bank of DEF Enterprise decreased by 29,600, putting it on the credit side. At the same time, their loan account received debit of 29,600, while the amount that is owed to Maybank, which makes it the account payable, decreased by 29,600, putting it on the credit side. On the 19th, Wawa Cafe returned one can of soda drinks worth 9,600 due to defective. That means to record it on the journal entry, Wawa Cafe received 9,600 due to them receiving from sales returns, which means that DF Enterprise had credit side of 9,600 due to the sales returns, and Wawa Cafe had a debit side of 9,600. On the 20th, a tablet was purchased worth 20,000 by cash, which means that on the debit side, equipment was received, which means that there was a 2,000 ringgit increase, and on the credit side, the cash by hand decreased, which means that we can record the credit of being 2,000. And on the 24th, Wawa Cafe paid 5,400 by check. That means that cash in bank for DF Enterprise increased by 5,400, putting it on the debit side, while Wawa Cafe's cash has decreased, which puts them in the credit side. On the 27th, Stephen withdrew 1,700 worth of inventory for marketing promotion. On the debit side, marketing increased by 1,700, while inventory decreased on the credit side by 1,700. On the 29th, 420,000 was paid to XYZ Enterprise by bank. To record this in the journal entries, XYZ Enterprise received 420,000, putting them on the debit side, while cash in bank decreased by 420,000, putting it on the credit side. On the 30th, Stephen invested 3,000 for business by bank. That means that on the debit side, investment was 3,000, while cash in bank decreased by 3,000, putting it on the credit side. On the 31st, 20,000 ringgit worth of wages was paid to employees by cash. Employees received 20,000, putting it on the debit side, while on the credit side, cash in bank decreased by 20,000.
Hi and good morning, Madam Ilya. I'm Izwan from Group 4. Today, I want to explain about ledger entries. What is a ledger? A ledger is a record of all financial transactions in a company, grouped by account. It will transactions from the journal are posted for more detailed tracking. What are ledger entries? A ledger entry is when you transfer data from the journal to the ledger. It includes date, description, debit amount, credit amount. Each transaction involves both a debit and a credit, following the double entry system. How ledger entries works? Here an example. Transaction: your company received 1,000 in cash for service. For the journal entry, debit cash 1,000, credit service revenue 1,000. For the ledger entry, cash account, debit 1,000, service revenue account, credit 1,000. For the type of ledger account fall into categories: asset, liability, equity, revenue, expenses. And why ledger entries matter? Ledger entries help keep financial record accurate. organize transaction by account, prepare financial statement, ensure everything balanced. For the conclusion, in summary, ledger entries are essential for tracking and organizing financial transactions, helping business stay on top of their finances and comply with accounting standards. Thank you, Madam.
A very good morning to Madam Elia and also my fellow friends. So, I'm Muniswaran. I'm one of the group member from Group 4, Madam. So, I'll be presenting about the trial balance. So, the first is the definition. The definition of trial balance is a financial report that lists all the balance in a company, generally ledger accounts at a specific point in time. It is primarily used to verify that the total of all debit balance equals the total of all credit balance, ensuring the accuracy of company bookkeeping system. This is an essential step in the accounting process before preparing formal financial statements. So, moving to the next point is the purpose. The purpose of this trial balance is to ensure the accuracy of bookkeeping and detect any mathematical errors in ledger postings. The second one is to serve as the foundation for preparing financial statements like the income statements and also balance sheets and cash flow statements. Then moving to the next one is structure. The structure of this trial balance is all accounts from the ledger such as assets, which comes from cash, accounts receivable, inventory, and also the next one is liabilities, which is account payable, loans. The next one is equity. Equity is owner's capital and retains earnings. The last one is revenue and expenses, which include sales, wages, rent, and also utilities. So these are the types of example of trial balance, Madam. So the limitation in this trial balance is a balanced trial balance does not guarantee the absence of error. For example, incorrect amount posted to the wrong account or duplicate entries will result in a balanced trial balance. That's all from me, Madam. Thank you.
Madam, my name is Simon Stephen Joel. My program is the Diploma in Logistic Management. So I want to talk about the financial statement. First of all, in the statement of profit or losses is a key financial document that provides a clear overview of a company's performance over a specific period, typically quarterly or annually. It starts with revenue, which represents the total income generated from the company's core operations, such as sales of goods or services. From there, we subtract the cost of goods sold. The short form is COGS, which reflects the direct cost associated with producing the goods or services sold, resulting in gross profit. This figure shows the basic profitability from the company's core activities before accounting for other operating expenses. These expenses include marketing, administrative costs, and rent are subtracted to calculate the operating profit, also known as EBIT, earnings before interest and taxes, which reveals the profitability from regular business operation. After accounting for operating expenses, we then consider other income and expenses such as interest income or expenses which are not part of daily operation. The result is the net profit before tax EBT. Following this, we subtract the income tax expenses to reach the final figure, net profit after tax, net income, which shows the company's ultimate profitability. A positive net income indicates a profit, while a negative number signals a loss. This statement is essential for stakeholders, investors, managers, and creators because it helps assess a company's financial health, profitability, and efficiency, guiding strategic decision and future planning. And also I want to talk about the statement of financial position. So statement of financial position, as known as the balance sheet, this financial statement is a snapshot of a company financial health at a specific point in time, providing vital insights into its assets, liabilities, and equity. Assets represent what the company owns and are divided into current assets such as cash and account receivable, and non-current assets like property, equipment, and intangible asset. On the other side of the equation, liabilities show what the company owes, with current liabilities including account payable and short-term debts, while non-current liabilities represent long-term financial obligations. Finally, equity reflects the ownership interest in the companies, including share capital and retained earning, giving a clear picture of the company's financial foundation. The statement of financial position follows a fundamental equation, that is, asset equals to liabilities plus equity. This means that everything a company owns is financial either through debt or shareholders' investment. By analyzing this statement, we can assess a company's liquidity or its ability to meet short-term obligation, as well as its solvency or its ability to pay off long-term debt. The balance sheet not only shows the financial structure of a company, but also helps investors, creditors, and management make informed decisions about its future. Ultimately, the statement of financial position is a crucial tool in understanding a company's stability, potential for growth, and also overall financial health. That's all for me. Thank you. My name is Simon. So I just want to talk about the conclusion of our part A. So in conclusion, learning the fundamentals of accounting gives students a basic understanding of the procedure and guiding concept that underpin financial reporting and tracking. Effective financial data management can be achieved by people who understand fundamental ideas like a double entry system, the accounting equation, and the creation of simple financial statements. Furthermore, maintaining accuracy and openness in financial reporting requires an understanding of journal entries, ledger accounts, and accounting cycle. Gaining an understanding of these fundamental accounting concepts is essential for both professional and personal financial management, since it sets the stage for more in-depth research and real-world application in the subject. So that's all for me. That's all for us, man. Thank you so much.